Alright, so welcome to another video on how to secure yourself financially. So this video, I'm going to talk about the beginner guide to financial statement to make a quick recap of this section made by the SEC, the Securities and Exchange Commission. So after all, financial statement, they show you the money, okay? And we have four types of financial statements: balance sheet that show what a company owns and what it owes at a fixed point in time; income statement, how much money a company may and spend over a period of time; cash flow, the exchange of money between the company and the outside world; as well as the statement of the shareholders that show change in the interest over time. So this section only focuses on the first three of them. So balance sheet, the PLDR is a snapshot of the company assets, liabilities, and shareholders' equity, where it's generally listed based on, in the case of assets, how quickly it can be converted into cash. So you have current assets and non-current assets. The first is asset that can be converted into cash within a year or less. So for example, inventory, non-current non-current assets are things that will take longer than a year to be converted into cash, and something called fixed assets that allow to this business to run. So they are not for sale: equipment, machinery, digital equipment, for example, a laptop, mobile, keyboard, mouse, you name it. The liabilities are generally listed based on their due dates. So you have current liabilities, the obligations that a company has to pay off within a year or less, and long-term liabilities due in more than 1 year. And the equity or shareholders' equity, which show is the money if, for example, the company hypothetically decide to sell all their investment or all their assets, as well as pay off all its liabilities. So the leftover money will belongs to the shareholders. And this it shows the companies. So this is the amount of money that the owners invest in the company stocks, plus or minus earning or losses since inception. And then I look at the income statement, where you can think of that as a set of stairs, where you start at the top with the total amount of revenue, and once you go each down the stair, you make certain deduction associated with earning that revenue. And when you reach the bottom line or the bottom of the stair, you know how much money a company made or lost. So generally, broadly speaking, you start with the revenue, okay, with the total amount of revenue, and then you deduct things like and then you deduct things like money that a company doesn't expect to collect, such as merchandise returns or discounts. So you reach to the net gross, okay? And from there you deduct things like the cost of sales, which is how much money a company is paying to produce the good and service over a period of time. After that, once you deduct that, you reach to the gross profit. Then you deduct is the operating expense, so expense that a company incur for their daily activities such as marketing or administering salaries, research new products and prototypes, or improving existing ones. So once you deduct that, you reach to the net income before interest and income taxes. So also you deduct things like depreciation and amortizations and the interest, which is, broadly speaking, is how much money a company made or spent for borrow money or money that lends to others. And ultimately the income taxes, the money that you owe to the government. So with that, then I look at the cash flow, which reports the cash flow inflows and outflows of a company over a period of time. So it reviews the information from the balance sheet as well as the income statement. And the bottom line of this show the net increase or decrease in cash. So this is important because company, much like persons, must have cash on hand to pay this expense or to purchase assets. So with that, generally this is organized in three types. So you have is the operating expense. So the cash flow statements is generally look or view the cash flow from one of these activities: operating, financing, and investing. So operating, what it does, this first part of the cash flow statement, okay? What? Holy, oh my god. Oh my god, there's on fire in Yahoo. Oh my god, there is on fire in Yahoo. What was that? Okay. So if I reload this. Okay. That was very weird. That was very weird. In any case, okay. Cash flow. Okay. So things like this. So the cash flow is, well, this is the operating cash flow. Okay. And the first part of this cash flow statement, it looked the net income from the income statement and conciliate with the total amount of cash that was used for other operating assets or liabilities, for operating activities. So the most common operating activities are operating assets and operating liabilities. Operating assets, we have things like inventory, accounts receivables, prepay expense that a company incur for goods and services they're going to provide, such as health or premium insurance, like health for medical coverage, or car and vehicle to protect those belonging in the case of any potential damage or accident, as well as the disability, liabilities in the case of lawsuits, in long-term care like nurse home care or home health care, marketing, rent, office supplies, software license, and maintenance contracts are another examples of the prepay expense. intangible assets like patent, exclusive right to provide like patents, exclusive right to provide exclusive rights to inventors so they can manufacture, distribute, and sell their inventions over a period of time. So the most popular game-changing in 2020 or in 2000 in this 20th century, according to Popular Mechanics website, is the maglev, this electromagnetic inductive system for stabilization and suspension for ground vehicles, issued in 1969. GPS, this navigation system using satellites with passive ranging techniques. Electronic device, as their patent name called, or aka mobile phone, issued in 2007. GPS was issued in 1974. CRISP gene editing, which is a gene editing tool, issued in 2014. So you get the idea. And also we have is trademarks, image designs, or audio video that uniquely identify this company from the competition. So for example, Michael Buffer and his famous quote, "Let's get ready to rumble." Copyrights, where now this is exclusive rights to creator of original works to manufacture, distribute their inventions over a period of time, such as McDonald's, Twitter, Netflix, Spotify. Trade secrets, confidential data that a company have to gain competitive advantage over. It can be process formulas and any other things like that. And customer relationship as well, goodwill, the brand recognitions, the brand's recognitions, reputations, and customer loyalty. And also I look at the investment in affiliates, whether it's joint ventures, equity investment, limited partnerships, associate, right? Where now this, okay, is more like when a company decides to purchase significant amount of stakes in the another company to influence, but not get total control of over the another company. And they do that because they want to earn a return from that or gain some competitive advantage. Cash and cash equivalents, like money market funds, which are funds that invest primarily in very short-term debt financial instruments, such as bank acceptance, debt issued by banks, or very short the term issued by bank, certificate of deposits, certificate of savings with short-term maturity, commercial papers, unsecured short-term corporate debt, or a repurchase agreement, meaning the short-term debt issued by governments. So once I look at the most common operating activities, okay, then I look at the most common operating liabilities, such as accounts receivable, money that you owe to suppliers and vendors, such as for example, raw materials, service, office supplies, accrue expense, money that you own, or money that a company incur for good and service that has been received but not yet paid for. Okay, so for example, wage and salaries, rent, utility bills, taxes, deferred revenue, which are obligations that a company has to provide a good and service over a period of time from money that has been collected, such as Netflix or the subscription service, Netflix, Spotify, or gift cards, income taxes, money that a company owns to governments, that it can be corporate taxes. In the US is 21%. Sale taxes, whether it's a county or state or city. VAT, the value added tax, which is a tax imposed on the production or at each stage of the production and distribution of good and service, where the customer ultimately folds the VAT. In business, along the supply chain, remit that portion to the tax, excise tax, which are tax imposed to certain goods like alcohol, tobacco, like alcohol, tobacco, gasoline, guns, and something called GST, the good and service taxes, that applies on VAT in places like Canada, India, or Australia. Great. Also, I look at short-term borrowings. So for example, a company that wants to meet their financial needs and they need to repay that. For example, bank loans, limit of credit, line of credits, bank loans, line of credits, commercial paper. So the issue is debt, so they can raise funds to meet their financial needs or their working capital needs. Okay, which is the difference from the operating assets minus the current assets minus the current liabilities. Okay, this is one of the metrics to know of more about the financial health of a company. Trades, credit. Okay, so for example, now he renegotiate is the payment for their suppliers and vendors, outstanding invoice, so we can raise funds for based on the value of the company outstanding invoice. So the lenders evaluate that and they borrow money. Payroll advance, okay, money that the company gives to the employees so they can is on the next payday deduct from there. And notes payables, where now this is a in Spanish this is called pagaré, but this notes payable, okay, is a is an obligation or is an agreement, okay, between the borrower and the lenders, where it outline is the terms and conditions of that loan. So in contrast with the short-term borrowing, this is not constrained by time, but by the agreement or the TOS of the service agreement of that loan, TOS. So you have banks, So anytime the company asks a loan for a bank, it generates is a notes payable, indicating is the principal, the money amount, the original amount borrowed, the principal, the interest, repayment schedule, among other details. Companies or business such as private equity or venture capitalists, where they now needed to reach and create this agreement for the company and this financial institution. Bonds, which are, for example, debt that a lender can purchase from a company or a government in the form of these certificates, okay, that it guarantees the principal plus interest payment, previous payment dates, payment dates agreement. Also, we have is trade payables, but now this is when you renegotiate with your suppliers and vendors. So you create this agreement. Also for small individuals or notes payable to individuals or business, okay, as well as installment loans. So when an individual or business asks for a loan to purchase an equipment or an asset, so it creates this payable note. And another common operating liabilities is warranties, obligations to provide, to fix or to replace that defective product with a new one, or product that doesn't meet certain quality standards. So you have is manufacturer warranties, service, parts, software, vehicles, that kind of thing. So that was a great recap, okay? Because once I look at the most common operating activities, whether it's operating assets or operating liabilities, okay, then since this is the first part of the cash flow statement, all right, and the way to do that is by look at the net income from the income statement, okay, and then conciliate that with, or adjust that with the total amount of non-cash items, so items that affect the income statement without any cash involved, such as depreciation or amortization, stock-based compensation, and the total amount of cash that was used the total amount of cash that was used or provide from other operating activities. And then the second is the investing. The second part of the cash flow is investing. Investing operations. So the cash flow review from this investing operations. This section review the cash flow from investing operations, where generally rely on the purchase or sale of long-term assets. Long-term assets can be property, plant, and equipment, investment in affiliate, or in this case, investment. Okay, property, plant, and equipment, investment, intangible assets, patents, goodwill, uh, copyrights, trademarks, trade secrets. Uh, Leasehold installments. Okay. Leasehold installment. Mm-hmm. So this is the investing cash flow. Okay. So for example, if a company purchases a equipment, let's say the machinery or a laptop. Okay. So this activity is registered as a cash outflow because cash was used for that operation. However, if a company decides to sell some of their investment in a portfolio, this operation is registered as a cash inflow, or as a inflow, cash inflow, cash inflow. It's a cash inflow. All right. And now, when you look at the financing activities, and when I ask here about the most common investing activities, okay, most common investing activity here, that's right. So, most common investing activities. Okay, so financing activities, for example. So, these financing activities are transactions. Uh, yeah, financing activities are transactions that involve the company's liabilities or long-term. Okay, so these financing activities are operations that involve the company long-term liabilities and equity. Okay, to put it short, so financing activities. Okay, so financing activities are transactions that involve the company's long-term liabilities and equity. So this activity primarily involves raising capital from investors, but you're gonna again, the financial activities involved in the company long-term liabilities and equity. That's what happened. Company long-term liabilities and equity, meaning ownership and the obligations with them to provide something. Okay, and these activities primarily involve raising capital. Mhm. And these activities primarily involve raising capital from investors or creditor to fund the company's operation. Mhm. Okay, and this activity primarily involves raising funds from investors or creditors for your company's operations, repay debt, or distribute profits to shareholders. So, with this introduction, according to ChatGPT, and then I look at the financing activities from Investopedia, cash flow statements, analyzing financing statements, Cash flow from investing activity explained. So cash flow from investing activities, one of the sections on the cash flow statement that report how much cash has been generated or spent from various investment related activities in a specific period. So cash flow statements analyzing cash flow from financing activities. The cash flow statements look at the inflow or outflow of cash within a company. Exactly. The financing activity in the cash flow statement focus on how a firm raised capital and paid it back to investor through capital markets. Very, very interesting definition. The financing activities is how a company raised capital and paid back to investors through capital markets. The cash flow from financing activity help investors see how often and how much a company raised capital and source of the capital. Holy fudge. Okay. So that'll be all for this video. Take care. Bye-bye.